But is that the word coming in from Sandeep Tandon also or not? The CIO at Quant Mutual Fund. He joins us on the show right now. Sandeep, hi, good morning. So much to talk about. I mean, there's Trump, there's trade wars, tariffs, the dollar dynamics, US equity markets getting a little bit shaky right now. And for us also, the Nifty already at an 8-month low. And I'm not even talking about the damage to individual portfolios and, concentrated small and mid-cap segments. Tell me, as an Indian investor, how is it that you should actually, tune your psychology right now, more importantly?
So, so if you recollect, I have been talking about last year, the biggest risk was the expectation risk because last 4 years, right from 2020 till 2024, we have seen extraordinary returns. So expectation level was really high. Okay. And this correction, whatever we are seeing, is a very common correction, even in the bull run, or even if I call it structured bull run or cyclical bull run sort of thing. Also, you do get these 15-20% correction, even sometime even more also. What is very important is the absolute and relative thing, because we got used to certain outperformance, got used to certain absolute returns, and that's the reason I think the pain point is much more. And obviously, at the peak of the cycle, the risk appetite is highest. The investor confidence, everybody is a long-term investor, and maybe a few months when it shakes everybody. So we have seen extreme last year. Now we are going through other side of the extreme, and that's the way your maturity comes. If you have seen cycles, how you manage that particular crisis, how you deal with this situation. And that's the way I think, a good amount of negativity is there. The buy on dip thesis has gone completely, is completely sell on rise. People are very, very, cautious sort of thing, if I have to call it the bullish capitulation is also the thought process also capitulated, not only the position. So that's a typical signs that you are coming closer to a bottoming formation, which is there. This is what we wrote in our fact sheet. At least on the broader market, NSE or BSE 500 is giving you some signs that, we are coming closer to bottom. So nobody has bought exactly at the bottom and nobody has sold exactly at the peak. So I think time has come to nibble into it and see what is very important to understand right now. The biggest worry when Trump took oath or post 5th November was the dollar. Okay. The dollar index has rallied sharply. Now, if you really look at in last, right from his second week of January, dollar has actually corrected against not only the emerging market currencies, corrected against developed market currency. So I think for us, the biggest good news is that DXY is also broken 106 mark also, which means this is a very positive construct for the emerging market. I'm not talking about even in India because we are part of emerging market basket. If emerging market does well, we are by default beneficiary of that. So currency is in your favor, which was the biggest perceived risk for most of us. And I still believe that from a medium term perspective, the risk is not over. But from a very near term perspective, it is showing amazing signs of weakness, which is very good background. Second important parameter is the crude. Okay, being a net importer of crude sort of things, then we are also beneficiary of the weak crude prices. Gold has been very high, which is again good news for India, where because the wealth effect which is there, when your holdings are moving up, your wealth is moving up, then you have a different level of conviction and confidence. So I think a lot of things are in favor of Indian investor. I think is some amount of mental balance is required right now to deal with this situation. That's the way I will say, I don't think up to that extent we are negative up to that extent the way people have given up. I think I'm a very selective buyer, even in the small cap. So we are actually looking for opportunity to participate now rather than getting too much stressed out what is happening to the global markets.
Sure. I completely get your point, Sandeep, about how, there are signs of dollar actually reversing. That's one leg of it. But right now in these tariff times, and, as we speak, there is the State of the Union address currently on, and Donald Trump is talking about how China, Brazil, Mexico, and even India has very high tariffs. We're still awaiting any, significant commentary on tariffs. But the thing is that if all this tariff implementation happens in Canada, Mexico, India, and all other countries, the point is that there will be a global growth slowdown. Up until now, the weakness in India was dollar and India earnings slowdown led. We didn't see a global sell-off as we did in a 2008, as we did in a COVID. What happens then in that case if across the board you see a slowdown in global growth?
See, let's understand Trump's psychology. Okay. Now, if he is going to put such high tariffs everywhere, ultimately he is going to destroy US economy itself because the inflation will go to the roof. Okay. And that's our larger thesis call also. The yields and inflation are in will remain elevated for a longer perspective. But even if I have to look at from a very near term and medium term perspective, a step which he is taking is going to hurt most of the US consumer. And I think any leader will not tolerate rising inflation because generally goes against their popularity votes in US also. So I think it's a strategy what Trump is playing right now, create so much noise, okay, and put so much pressure on the global leaders so they come and settle with him. And that's the way I think is a more of certain characteristics everybody has. I think he has his characteristic where he will try to destabilize first, shake your confidence completely, and then settle it. Now, if you are hearing a news right from January, we are seeing first February it's getting implemented. Now April has come, and now again some talks are coming that we'll again review it. So I think if I have to go purely from a noise perspective, I think he also knows that whatever he can do it in the initial part of his term. So maybe first 6 months can be challenging. Maybe I personally expect that maybe by June, July, all this trade related issues which is there with US will settle down. That's the reason I said second half will be better or noise will settle down. And I think he's a shrewd businessman. He is looking at his 4 month, 4 years tenure as a CEO of a country. And this all the step which he's taking, which is the larger interest of US in the medium term, but ultimately what step he's taking, he will destroy the US as a superpower status which country has. So he's looking at a very short term and medium term needs, which has its own repercussions. So maybe after this correction which is going on US, and we have been saying from January, the vulnerability in US is highest because if I have to say, complacency indicator is at lifetime high, money flow towards US equity is lifetime high. These are all clear indication that people are so complacent out there, and hence means larger vulnerability. I have said that the situation we were in July 2024 India, the India complacency was very high, and we got into a minor risk of environment. That's something similar is there in US market right from January 2025, and hence you are seeing this correction. But again, what we have to look at is that if US is going to correct sharply, again the worry comes from our mind. India will also fall accordingly. I personally don't see, because I think India has already corrected significantly, and if currency stabilize, I think there'll be opportunity. And we are also seeing some signs of exhaustion. I'm not saying completely, but some early signs of exhaustion in the FI selling also. So I will watch for the global yields. I will watch for the global currency movements, and accordingly we'll take a call on that in global equities.
So let's come back to India, since you said that the time has come to nibble in right now, purely at an index level. And Sandeep, since you do track technicals as well, we've hit the lowest RSI since March 2020 already. We're at an 8 month low. What is the screen telling you? Do you think we're at the end of the pain at an index level per se?
See, to be candid with you, I am not a great chartist, okay, or technical technician in that sense. I'm a good observer, and we are predominantly a behavior house. So we look at more from a inflection point rather than say looking at the breakout or breakdown, because that may not give you a correct perspective, or we may not have that ability to read up to that extent. What we are looking at, when we said in July 2024 the complacency was high, we are at extreme inflection. Maybe September, October, India liquidity peaked out, that was the extreme inflection end. Now, if I have to say with good amount of confidence, whether are we seeing something similar inflection points on the other side in the most of the indices, the answer is big no. But if I have to get into some stocks, then answer is big yes. Many stocks are now have reached out and they are trading in the hated zone or neglected zone. That's the way behaviorally we define. So I'm looking for those opportunity where stock has already corrected significantly from admired territory, and now they're trading in neglected zone. Nobody can get it perfect bottom. But when stocks hits neglected zone or remain there for a long period of time, your downside is at least protected. So we are looking at those ideas where we see my downside is protected. But because in this environment, like we always say, the risk of environment, safety first, liquidity secondary, and you have to protect. Okay. With that background, I think these are good safety stocks where downside could be limited and maybe upside can be very meaningful whenever market recovers. and when we see a risk on environment. So I think I will not play with the thesis of particular index level. And it's they are more of a psychological level. Now, a lot of people are looking at 21,800, where we have seen a budget low of 22,500, 21,500 sort of thing. So I think those are psychological numbers. Can market test or retest those levels? Maybe answer is yes, but I will not play index game. I will look for stock specific opportunity. We have been cautious for a while. That's the reason we are getting brilliant opportunity to deploy money. Selectively, I am buyer in the stock, including the small caps names.
Interesting. Since it is safety first right now, Sandeep, would you say have a bias and tilt towards large caps, or do you think it's meaningless? It's really now about individual stocks and companies.
See, when you look at on a relative basis, like right, we believe that large and mega large will still outperform small and mid. Okay, that is more from a relative basis. Okay, but we also have to look at in absolute terms where opportunities are emerging. So that's the reason it's a better approach to look at stocks rather than maybe you have to live with a short-term pain in some of these names also, because you get tired that you bought and the stocks are not moving, still struggling or maybe marginally correcting only. So the way I look at in the opportunity is that let's identify stocks which have reached neglected and hated zone and keep on accumulating these names, because the reversal when happen when you see a risk on cycle coming back, and that's the time these stocks will rebound sharply because they have already corrected their journey, more from a price correction also as well the time correction also. So I think the approach will be slightly different. We will definitely avoid all those stocks names, which have till last year in the trading in the admirers zone. Okay, they have still not corrected. I think the downside is much more in so-called these hype stocks where correction can be still very meaningful, and a lot of people are hiding there. If you looking at from the large family office, ultra HNI customer, including FIs and domestic mutual fund, these were the stock which has performed very well in last 4 years, and people are hiding. I think I'm more concerned about such names rather than looking at opportunity where correction is very meaningful. Ultimately, see, it's all about earnings, okay? And if the multiple has shrunk a lot, and if we see earning momentum in some of these names, then I should be looking at the buying opportunity rather than saying that, let's see index to bottom out or mid and small to be bottom out. Then we take a conscious call. We may not get it at that price, maybe at so it makes sense to participate currently also. I'm not saying one should be very aggressive buyer, but one should be selective buyer.
Hi Sandeep, good morning. This is Shrishti also joining in. So now is if it's the time to actually go ahead and look for some buying opportunities, if you can help us understand that which are the stocks or sectors that you are eyeing at this point in time, because the last time we connected, you believed that FMCG and staples could make a comeback. IT and banks were not in your preference list, but has anything changed? And we also get a sense that this year belongs to individual stocks rather than sectors. So if you can give us some sense there.
So I think given the noise which is there, okay, it makes a lot of sense to more focus on the domestic consumption, domestic economies. So I think capex cycle got affected in last many quarters or so. I think government spending will start increasing. So we remain very constructive on the large infra names, okay, because ultimately India has to grow, capex will stay. So large infra is followed by materials. Also, if infra has to put in place, then materials will play a role. So those are two important sector for me. Then I think pharmaceutical has also corrected. And even if I go by the tariff noise, also US cannot afford to deploy very large tariff on the generic side, because life will become difficult for the consumer out here in US itself. So I think that is another area which we like. We like hotels and hospitality as a sector. And with not only banks, I will say overall financial services firms looks good, which include insurance also, NBFC also. I think buying opportunity is there, and they have been trading in the neglected zone for a while. So, and with some recent changes in the RBI circular also, it's clearly give indication that these are the names where my downside is limited and upside could be meaningful.
All right, but Sandeep, specifically, if you can talk to us about the IT space, because back then in January start, you were not liking that particular sector as a whole. And what we are seeing right now is that the stocks have already have their share bit of a correction. Is this a time to maybe look out for some IT counters?
The two problems with IT which we were facing for a while is that the if you look at earnings momentum is completely missing. They have their own challenges, okay, with the AI and ML coming to picture. So that's the first point. The call which we took in not to have IT in our portfolio was largely linked with the US market when we said in January, the vulnerability in US is high. And if I dissect that vulnerability, then we saw the one of the highest vulnerabilities there in the tech sector. Okay. So that's the reason we said that I will avoid this sector if I expect a correction or deep correction in US. We talked about 15% sort of correction in the US market itself. And if you look at with the lag effect, it's playing out quite well. So that thesis was more from earning perspective, and as background was US. So if US corrects sharply, let's say when corrects further, and if we get some opportunity, we will definitely lemble. We don't have any love or hate in relationship with any particular stock. We are pure opportunist. If we think opportunity is there and Nasdaq looks like bottoming out, I may look for buying opportunity also, but not at this point of time.
Talked about pharma being one of the preferred sectors. What within pharma, because it's a large pool as you look deeper, is it largely the CDMO players that you would stick with?
CDMO is also opportunity. Even domestic formulation business is doing well. Generic is another opportunity. That's why I said, irrespective of the tariff, US cannot afford. So I think I will look for a combination rather than just looking at one, because you have to a bit diversified portfolio, because the day you get a tariff news, some of stocks can even correct 5-6%. They can have a gap down opening. But I think opportunity. I see what is very important. I want to highlight about tariff. The tariff drama is going on right from January. Okay. Now, what we have to understand in a very mature manner, whether it is up to what extent is priced in. So it's now the tariff or the polity risk, which we were talking in January, is no more unknown risk. It's a perceived risk now. What is very important to understand, and without getting into too much noise which is there in the system right now, we have to really sit down and analyze whether it's factor or not. We think up to large extent this noises has factored, and that's the reason global market has corrected post tariff related challenges. So I think it is factored in, maybe 60-70%, maybe 10-20%, 30% correction can happen depending on which stock and which sector you see a bigger impact. But largely it has been factored, at least from India perspective.
Right. Sandeep, you also talked about infrastructure and materials as a segment. What gives you conviction about this space making a comeback? Is it cheap valuations, or do you think the government spending is going to kick in once again?
So I think, yes, valuations have again been attractive. And if I have to look at uh, India from a longer term perspective, India is one of the fastest growing economy in the world. And I'm not looking for just next 6 months perspective. If I look at for next few decades perspective, I think it's a great opportunity. And every forum, when you interact with the bureaucrats or listen to the policymakers, I think somewhere we expect, nobody has quantified or put in a timeline. This is what they're going to do, whether it's state government also. When you interact, you get a fairly good perspective. They are committed. I think it's a question of time. Budget has also endorsed up to that extent. A lot of people have given up, but I think a lot of stuff is happening, and I think we have to look at in a collective manner. See, it's a very human psyche, when market is going rallying, all negative news are actually ignored, and similarly when market corrects, even positive news are getting ignored. So I think we have to really sit down and analyze and try to see what is narrative and what is reality. Reality is that governments is committed, state governments are committed, large corporate houses are committed. So look for opportunity rather than saying that slowdown is there across the board. Let's say example, we own a lot of hotel stocks. Yes, consumption is not there, but hotels numbers are extremely good. So I'm saying, looking at, you have to identify such sector and such opportunity. And every crisis brings some opportunity. And don't look at the short-term pain for a quarter or 2 quarters, you might be visible. Ultimately, if we believe India long-term story, and I'm a pretty convinced from a longer-term perspective that something has changed for India. India Perception Analytics is also endorsing a secular bull run sort of thing, or a larger thesis is very constructive. Then I will look for opportunity. I think market has corrected. When we overheated correction, we have seen certain hype was there in certain some of the, let's say, private side of the market, the SMEs also, some of the mid and small segment also. I think we have seen good correction, and I said that avoid all those names which have seen good amount of hype and they were trading in the admire zone. I think those are the names if you can avoid, and many names are available in the deep value situation, and which includes mid also, small also and large also in a big way. So I think it's a stock specific opportunity you have to identify and try to psychologically remove this pain which we are seeing right now. It's not people say, let market settle down, then I will buy. I already have enough exposure. You may not get it at that particular price. So whenever you are getting opportunity, and if you have cash levels and you have a really liking for or risk appetite for Indian equities, which a lot of people had at the peak of the cycle, I think we should remove these noises or narrative which is there in the market from a very near-term perspective. I think let's look at stock-specific approach, and maybe 2025 will be far, December 2025 will be far better than what we are seeing currently.
All right, let's hope for that. But Sandeep, also share your thoughts for the energy sector as well, because you believe that energy could be the big theme for the next decade. And given this correction, what are your latest thoughts within the energy basket?
So I think energy is a decadal call. We are not looking at from this 1 or 2 years perspective. Whether talk about renewable side also, I think when we said that India could be self-sufficient by 2032, 33 sort of thing, I'm taking in a conservative manner, not by 2030. So even you take very conservative approach by 2033, then any companies are which is part of the renewable basket or putting efforts in the new energy space. I think those are the names, and they're talking about very sizable opportunities. So we are not talking about small players, and even thermal also we remain optimistic. Distribution companies will remain optimistic. This whole space is very constructive, irrespective of the noise in the market. I think earnings momentum will continue out here. Okay, and let's not forget about a month or so. Particular prices as this month was slightly weak, but if I have to look at the 10 years perspective, next 5 years perspective, this is the area where we have large holding, and it's a very focused approach. These are like core holdings from a decadal perspective. So we remain very constructive. In fact, we have been a buyer whenever we are getting opportunity in these names.
Sandeep, I also want to talk about, PSUs at large with you. I know the rationale now in the market, or the reworked rationale, I should say, is that don't look at umbrella strategy. You've got to go deep down, look at individual stocks. But what about the erstwhile PSU darlings, your defense, your railway names? Do you think they will also show some signs of leadership? And are they looking attractive right now? Because the first correction actually creeped into these sectors.
So let's understand the thesis of a PSU from a larger perspective. So when we as a house say that this decade belongs to value, okay, and obviously PSU fits very well in that larger thesis. But you also keep in mind PSU stocks have high beta, okay, and this is the one area where a lot of people have ignored. And by end of 2024, or let's say by mid of 2024, we have seen some sort of hype getting built in defense, railway, and many more such names were there in defense and railway particularly, and even some of the logistic names. So we have seen some amount of extreme euphoric move happening in some of these names. And so it's a very naturally that they have corrected. I think correction is also quite meaningful now. If you personally ask me, we as a house believe that opportunity has come to rebuild PSU exposure, which we have started doing very selectively. We are buyer in PSU names also. See, again, when there was signs of euphoria, we actually cut our exposure. Now we are rebuilding our exposure, keeping in mind the valuation is great. See, the good part about PSU is that liquidity is amazing. Okay, they are fairly liquid names. So the big challenge which we generally market is facing right now is about the impact cost. The impact cost of the PSU stocks are still on the lower side. You can get exit and entry if you want to buy 50 lakh shares or 1 crore share or some of these names. It's very easy to do that because liquidity is pretty high. So this is one important criteria, I think, which now market will start recognizing, that you have to have your liquid stocks in your portfolio irrespective of the valuation. So because for whatever reason, if you face any redemptions or you face any challenges or you want to do sector rotation or stock rotation, you will not able to do it if these names are illiquid. So from the liquidity perspective, impact cost perspective, PSU actually is the right tick box for us. And valuations has corrected a lot. So I think I'm a larger thesis. I still remain equally constructive on PSU because I always said that it's a decadal call. It's not a call which you say for the next 2 years, 3 years perspective. And now time is right to rebuild your exposure selectively. Even in the PSU space, one can do that. And this is something what we are doing right now.
Interesting. So, Sandeep, if an investor comes to you right now and wants to invest purely in mutual funds and has managed to time the market, is sitting on a pile of cash with a medium risk appetite, what kind of mutual fund portfolio would you construct for them?
See, we generally advise when environment becomes difficult, let's say it's largely a risk off phase in the market, which is very difficult to navigate for most of the people. The best strategy is to go for flexi cap type of funds, because a money manager get highest amount of flexibility, these things, depending on the opportunity to shift from small and mid to large or large and mid to small. So that's flexibility the money manager has. That's the one of the reason we believe that the flexi caps are good. Or if risk appetite of particular investor is on the lower side, then he can go for hybrid schemes also, and particularly the multi-asset side, because you do get diversification, and not only from the equities perspective, more from the asset class perspective. Again, a very flexible product where money manager has a lot of flexibility to rotate not only stocks but the sector itself, or but the asset class itself. So I think these are the two names. For a conservative, I will say multi-asset, and somebody has a high risk appetite should go for flexi in this difficult and challenging environment where instead of you choosing mid or small or large, okay, an environment changes, let's say down the line 2 months or 3 months, okay, and you may not able to flip or rotate your portfolio up to that extent the way money manager can do it, because this is our full-time job. So it's better to go with this approach rather than getting into a thematic. See, if you really look at the peak of the cycle in September, October, we have seen gush of liquidity coming towards thematic funds. Okay, and thematic funds being from the same industry, and we can say that the thematic funds obviously are more risky and more concentrated. But whenever risk appetite is high, you saw the maximum liquidity. That itself is a sign, and lot many investors are now stuck with the thematic funds. So I will still not advise that one should venture into any thematic fund at this stage. It's more of a flexi cap or multi-asset approach will yield better returns.
Interesting. Sandeep, Jan, when we spoke, your investment philosophy was stay active and an absolute focus on returns. I'm sure you've tweaked that narrative now.
So, we have to practice, we can talk about it, but ultimately we have to demonstrate it. A lot of people are saying, I'm extremely negative and mid and small and other things, the narrative we keep on hearing in the media. But ultimately, you have to demonstrate in your portfolio. Right from July, when we said it's a risk off, we actually moved out from mid and small to large and mega large. We moved out from high beta to low beta and from high illiquid to liquid. We demonstrated we underperformed also, because markets mid and small rallied till September, and some of the stocks even rallied till December also. So it's all about, see, theoretically, a lot of things looks very nice, but ultimately we have to demonstrate in your action. And that's the reason as a quant, we talk about a dynamic style of money management based on the risk on risk of environment. We have to be early. See, the risk is all about you have to be early in the taking a risk call rather than be late on that part. If you have to be ahead of the curve in taking a risk call. So risk is very important for us and something we actually practice. It's not about just talking about it, that this is what we do. We actually demonstrate it. And sometimes underperformance is a part of a strategy. You have to live with that thesis, because every sector, every quarter, every year, every month, you cannot be leading the chart. So this is something a lot of people people look at absolute return, people look at relative return. I always say, please look at risk adjusted return. What risk somebody is taking to generate this risk? And that is our focus area. Risk adjusted return is the right measure. And most of the time it remain on the nicely on the Excel sheet. Even best of the wealth manager don't talk about it. People just talked about underperformance part, on relative underperformance and absolute returns. So I think that approach has to change. Once you start accepting the risk adjusted returns approach, you will be more satisfied investor.
That's so true. And Sandeep, such great learning today talking to you. Thank you so much for your time.
Yeah, thanks a lot for inviting us.
Okay, words of wisdom, words of advice and strategies coming in from Sandeep Tandon from Quant Mutual Fund.
If you like this video, then like, share and subscribe to ET Now.